So the motivation for this project is the observation that companies are much less likely to list on public exchanges than they once were. So an exception to this is Uber, which is listing today, but otherwise we see many more companies staying private, either because they don't IPO or because they're purchased by private equity companies, they're funded by venture capital funds. And so this observation has many different implications across different parts of financial economics. One that we're going to focus on here is what this might do to our assessment of factor exposures. So on the left, I'm cutting by book to value and by small and large stocks, and the observation is that we have many fewer small and growth stocks on the public markets than we once did. So the typical stock today looks much more like a large growth stock than it once did previously. On the right, I'm picking up specifically these small growth stocks by their share in the value of the exchanges, and again you see that they account for a much smaller size of the overall market, consistent with this idea that the rise of private capital financing techniques, private equity, might be accounting for a shift in the relative factor exposure of what's listed publicly. And so this shift in capital towards private markets makes it more important to try to develop techniques that allow us to understand how risk is therefore priced in private markets. So we have a number of existing techniques that have been used to try to measure risk and return in private markets, such as private equity, which we're going to focus on here. Some of these approaches include TVPI, or cash in, cash out, which just measures the direct proportion of cash received by LPs for $1 of contribution. That doesn't take into account discounting, let alone risk. You have the IRR. Our discussant, Antoinette Shore, has developed a methodology, the PME, which is very nice because it allows for a replicating portfolio, one that assumes that a dollar is invested counterfactually in the S&P 500 instead of a private equity fund. This has been built on a little bit by Arthur Cordway and Stefan Nagel in the GPME, which still makes the assumption that the beta is going to be constant, and that all of these approaches have the common limitation that they're requiring one aggregate source of risk. And so what we'd like to do in this paper is develop a novel methodology for assessing risk and return in generic streams of cash flows that we're going to apply to private equity. That's going to allow us to develop, we think, a little bit richer methodology for understanding risk and return. And so to do so, we're going to borrow from a rich literature in asset pricing, which has really emphasized the importance of the cross-section in factors, as well as the term structure of risk. So the term structure is going to be really important here because we're interested in understanding private equity cash flows, which are returned back to the LPs with a considerable amount of time lag, right? Typically 10, 15 years for the cash to come back. So it's going to be very important to know what are the relevant term structure of risks that investors are taking on for that kind of locked-in capital contribution. So we're going to have the problem in doing this that we observe cash flows in private equity, not returns, right? So we have a ton of methodology in asset pricing to understand factor exposures when we have return data that we cannot use when we have only cash flows. And so to address that, we're going to develop this methodology, which works as follows. First, we're going to take publicly traded assets and we're going to strip them into the cash flows that come in at all different horizons. So this is, following very similarly from the work by Ralph and Jules. The innovation here is that rather than relying just on the subset of those publicly traded dividend strip data, we're going to have an asset pricing model that gives us dividend strips on a wide number of different assets. So we're going to have dividend strips for value, for growth, for small stocks, and so on and so forth. So what this is going to allow us to do is match maturity by maturity the cash that LPs receive when they invest in private equity funds. And so this will allow us to construct a replicating portfolio that is very well balanced in terms of the overall cash flow exposures to what private equity fund investors receive. And with this replicating portfolio in hand, we're then going to be able to do a lot of very nice asset pricing techniques like understanding the risk exposure, the expected returns, the risk-adjusted profits, and so on and so forth. So some of the key takeaways from analysis is we find that these private equity categories do tend to take on factor risk that is specific to their individual sector. By that I mean real estate private equity funds take on exposure to things that look like REITs, for instance. That may not be very surprising, but our methodology allows us to quantify the importance of these non-standard factor loadings. We find that over the life cycle of the fund, the risk exposure looks a little bit more equity-like early on in the life of the fund. We can talk about that maybe more in the discussion. We do find that profits and expected returns tend to be falling more in the recent data. And we do find that there is a substantial small and growth factor exposure in some private equity categories, sort of suggesting that these factor exposures have been eaten up in some sense by private equity. All right, so this is the raw data that we're trying to match. These are the cash flow distributions to limited partners and private equity funds across a number of different categories. You may already be familiar with the buyout and VC categories. Those are the ones most commonly discussed in the literature. But I want to emphasize that private equity also invests in a lot of other things. So for instance, we have a lot of funds in real estate private equity. We have infrastructure funds, debt funds, restructuring, and so forth. And each of these little histogram bars reflects the cash received by an investor at a particular horizon, at a particular quarter in time. And they kind of all generically sort of follow this hump-shaped distribution pattern. At the very end, we've got terminal cash flows, those that happen after year 15. It actually turns out we have quite a bit of cash flows that happens after the fund is supposedly no longer operating. This gives you a little bit of a sense of what's the variation in the data that we're interested in understanding. Each of these lines corresponds to a cash flow distribution sequence for a particular vintage, for a particular year in which the fund was originated. And we see sort of rich dynamics. So the life cycle dynamics that we're going to be matching on average is basically that hump-shaped profile that we're going to see across different vintages. And then we also see a little bit of variation depending on the business cycle at the time of fund origination. So our estimation is going to be trying to account for those two main sources of variation that determine the overall cash flow profiles of the funds. All right, so to do so, we are going to develop these different asset strips. So for the zero coupon bond, that's pretty straightforward. That's an asset that pays off zero in every period until a particular horizon t plus h for an investor that's buying this at time t. For the dividend strips, that's going to be an asset that pays off the claim to the aggregate dividend index, let's say, at time t plus h, nothing before and nothing afterwards. Similarly, we're going to have a defined dividend strip not just for the aggregate stock market, but also for REITs, for small stocks, for value, and so forth. The advantage of stripping out the cash in this way is that if you're thinking about a private equity fund with a defined horizon, you don't want to match that with equities that are paying off claims to assets that are paying off claims to dividends that might occur before or after at various points in time. By defining the specific horizon of cash flow, we're going to be able to match the cash received by the investors much more directly. So we're going to have prices for these different dividend strips that come from a model. I'll talk more about that in a few minutes. What I mentioned is that we have a process to match those dividend strips horizon by horizon. So for each particular quarter that we observe the cash flow coming from the fund, we have a corresponding dividend strip for that precise quarter. And we're going to match a number of different factors for each fund category that we've chosen to try to have a sort of a parsimonious balance of different factor mixes. So for buyout funds, we're going to be looking at the bond factor, stocks, and small. For VC, we're going to be looking at bond, growth, and small. And then for real estate and infrastructure, we're going to be taking bonds, stocks, and then a factor-specific factor exposure. We played around a lot with different types of factors. These are just a set of three that tend to, on balance, match well the cash flow profiles of each of these sectors, while also carrying some economic meaning as to why they're there. So when we estimate these loadings of different betas on the different factors that correspond to the dividend payouts for that particular horizon against the cash flow for the private equity fund, we're going to allow this beta to vary on two dimensions. First is going to be the age. So we're going to allow every single age of the fund to have a different beta. So we're going to allow for this exposure to be more weighted to equity or to bond at different parts of the fund life cycle. And we're going to allow it to vary based on the tercile of the price to dividend ratio of the vintage origination year. So we're going to look at the marketing conditions basically at the time the fund was started and use that as an additional conditioning variable to discipline how we govern our replicating portfolio. When we do this estimation, we'll start with a baseline OLS model. We're also going to have a lasso estimation here. The key benefit of the lasso in this context is it allows us to generate a long-only portfolio. So we just shrink all of the negative estimates to 0, and so this results in a replicating portfolio that is realizable through long-only positions. All right, so that gives us the beta. Again, the beta is just what mix of different asset strips will replicate the cash flow for the private equity. We're then going to translate that into an explicit replicating portfolio through the use of our prices for these different strips. So I'll talk again where these prices come from, but the basic conceptual idea is that we want to price all the different claims that make up the replicating portfolio in a way such that it's budget feasible, right? It could be that private equity is well replicated through a series of cash flow exposures that are very expensive. And in that world, private equity is going to deliver a lot of value because it's giving you the same cash flow that you would otherwise have to pay a lot of money for in public markets. And so a replicating portfolio that uses the market prices of these different assets will allow us to really assess whether or not they're delivering risk-adjusted profits. We're also going to be able to look at expected returns. Again, that comes from a model. Because we have the factor loadings across the different segments, we're going to be able to understand what the returns are going to look like or suggested to look like in the future, even for funds that have just started operations today. And I'll mention our profit analysis is going to have the benefit that it adjusts for the cross-sectional factor exposure, but it does not correct for the illiquidity. So part of the additional outperformance of private equity here you could think of as being some sort of premium for illiquidity. As an aside, it's not even obvious that private equity does carry a meaningful premium for illiquidity. As we discussed with the pension funds that invest in this stuff quite heavily, they are able to recognize these assets at very favorable regulatory regimes that generates additional demand for private equity. So it's unclear even how to think about that liquidity premium. Perhaps we can talk about that more in the discussion. Just a few brief words on the asset pricing model. This is a fairly standard VAR approach in which we're going to include a large number of relevant bond variables, the short rate, realized inflation, 5 to 1 month treasury spread, as well as a number of stock variables. So the price to dividend ratio, dividend growth across a number of different factor categories. We have a pretty standard conditional log normal SDF. And just to kind of go through the asset pricing model briefly, it fits the data pretty well. So we can match the time series of the bond yields pretty well. We can match the underlying components of the bond yield, the real and nominal one. And we also match for the stock data pretty well. What I want to mention in a little bit more detail is what this looks like in terms of the term structure of different risk premia. So the thing that we're really going to take away from this asset pricing model is the rich dynamics across different factors and across the term structure of risk premia for these different factors. That's going to be very important in matching the precise characteristics of private equity funds. And one thing that I thought was pretty interesting here is if you look at the top right panel, so this is the dividend strip risk premium for equities in general. If you look at those two lines that are downward sloping, those are the futures risk premium. And so that's what's been discussed in Ralph and Jules' work, for instance, a downward sloping term structure of risk when you look at the dividend strip data. What we're focusing on here is actually the spot risk premium, which is actually upward sloping. The difference between these two is basically the nominal bond yield. And so what we find is that even though we match the downward sloping risk premium for the futures, we actually are going to be using a positively sloping, upward sloping term structure because we're focusing on the spot rates. So we use that data on dividend strips directly as well as a moment in our estimation. So the red line here corresponds to what the data indicates on dividend strip information, and the blue is what our model suggests. So on the right panel, I think this is kind of interesting. It illustrates one of Murphy's laws, which is even if you didn't think about what should be the share of the next 2 years worth of dividends on the stock market relative to the price. So that's what I'm plotting here, the 8-quarter cum dividend strips relative to the price. So even if you didn't think about what that should be, you might think it should be stationary. It doesn't particularly look like it's stationary. So it turns out actually that in more recent years, we've been valuing much more heavily the cash coming in at later points in time in equities relative to cash that's coming in sooner. So all this is obviously going to be very relevant for us in having measures of how to price these kinds of risks when we compare this to private equity funds. And again, the key takeaway for this exercise for us is that we're going to have prices across these different categories, bonds, stocks, REITs, and so forth, that have this rich dynamics in the time series and have a rich dynamics in the term structure of how different claims are going to be priced for cash that's coming in 1 year from now, 5 years from now, 10 years from now. All right, so to get to what we find in our estimation, we are looking here at buyout funds, and we have the loadings on bonds, small factors, and stocks. So we find fairly sizable stock loading across different horizons. We've got a bond loading that's a little bit more substantial later in horizons, and then we've got this last little tail of fairly heavy exposure in that sort of matching the terminal cash flow that we've aggregated together for all the cash coming in after year 15. We have an R-square of about 0.17 when we look at this in a panel setting. If we kind of collapse everything into a portfolio, we actually get a substantially higher R-squared of about 0.9, so indicating that there is a sort of a lot of idiosyncratic cash flow going on with these funds that sort of washes out on average. We find across the PD terciles, we've got a little bit higher loading for stock factors and the lower PD terciles rather than in the third one. And this is what it looks like when we move to our lasso estimation. So here we've constrained all the coefficients to be positive. We find pretty sizable equity loadings in sort of the first half of the fund life. Those are the loadings associated with small and stock factors, and then larger bond factor loadings later on in life. Here's what it looks like for VC. Here we see a greater role for growth factor as well as a small factor, sort of suggesting, again, that these alternative factor exposures are important in understanding this private equity category. For real estate, we observe a larger loading on REITs. That might not be very surprising to you that real estate funds have exposure that looks REIT-like to some extent, but our method allows us to quantify exactly how important we think this loading is and where in the fund's life it appears to be the greatest. This is what we have for infrastructure. Again, some evidence of loading on infrastructure-specific factors for this category. So taking all of those factor loadings together, putting those in a replicating portfolio, what we're able to do then is to compare what the profits look like. So compare the returns to $1 invested in the private equity fund with $1 invested in our replicating portfolio, investing at the same time that the fund starts. For the buyout category, we actually find fairly strong evidence of these risk-adjusted profits. Those are all the histogram plots on the right there. So those correspond to investors receiving more from private equity than they would have received from the replicating portfolio. These profits tend to be a little bit higher, in some prior periods. So the 90s, which is a time when many people think was sort of the golden age of private equity, is when we observe pretty high profits for the buyout category. We see this really strongly for venture capital. Here you see really high profits kind of in the 90s for venture capital, which have kind of gone down substantially since. And remember, residual profits here can reflect as well a compensation for illiquidity, as well as some sort of superior marketing advantage for the private equity managers in terms of their market timing and so forth. Another way of kind of assessing the relative performance of private equity managers here is to look at the IRRs of the replicating portfolios relative to the IRRs of an investment strategy that buys up all the private equity funds in that year. And so on average, it seems like our replicating portfolios are sort of matching sort of the changes relative to the private equity funds. But for the buyout category, we tend to observe that the buyout funds tend to outperform a little bit relative to that replicating portfolio. There's actually less evidence of outperformance in the other categories we look at. So our methodology is also able to look at expected returns. Here I'm giving you the expected returns across the life of the fund. So a lot of the expected return at different horizons here has to do with the stock factor. There's a fair amount of bond loading as well in the middle of the life of the fund. And we also have this return for the time series. So this actually follows, I think, very closely to what John Campbell was also discussing last night, in that the expected returns for private equity do seem to have gone down substantially. And this seems like a trend across different markets. Here, this measure of expected return is coming from our replicating portfolio. We benchmark our estimates relative to other approaches. So here, this is the risk-adjusted profit against the Kaplan-Schwarz PME. It's a fairly high correlation, suggesting that the approach does sort of seem to line up with other conventional measures of private equity, with sort of the additional advantages that it gives us a lot more detailed asset pricing things that we can do in terms of factor exposure, different categories, and things like expected returns. So just to wrap up, key contribution is to develop a new methodology to value private cash flows that allows us to assess the risk and return characteristics. We've applied that to private equity, finding that these funds do take on some asset-specific exposure and that their risk-adjusted profits have been, being sort of surprisingly well, but going down over time. Thank you.